Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question with a spreadsheet comes from Carl. Alan, this is what I did for the first set of options trades. One stock, CMSCA, I already owned. Is there anything obviously right or wrong about what I have? Are the ROE premiums or return on option too low? Are the up potentials too low? Thanks for your help, Carl. Okay, so Carl obviously sent me a spreadsheet showing the trades that he made on his very first covered call writing portfolio. So let me share that with you now, and then we can evaluate the portfolio. You could see from the spreadsheet that there were actually 5 stocks in the portfolio. 2 of them, CMSCA, which is the one that Carl told us he already had 2 option strikes, one at $37.50 and one at $40. At the very bottom of the spreadsheet, you could see PPC also had 2 strikes, one at $34 and one at $35. So if we took a look at the spreadsheet right now, you would notice that all of the strike prices are out of the money or higher than the current value of the stock, which is in the second column from the left. All right, so that said, Carl wants to evaluate whether or not the return on options or ROEs are good enough and whether the upside potentials are good enough, and basically wants an evaluation of his very first covered call writing portfolio. All right, so let's move on to start this evaluation process. And what we're going to do is we're going to take a look at the cash allocation aspect of Carl's portfolio. In other words, how much cash did he allocate to each position? Now, for the 2 stocks that had multiple strike prices, we added those up. So in the case of CMSCA, Carl actually had 600 shares. The case of PPC, Carl had 300 shares. And you could see starting from the top that there were 100 shares of ABBV. And if we multiplied the number of shares by current market value, the cash allocation column on the right side of the screenshot will show you the amount of cash that Carl allocated to each of these stock positions, whether it be 1 or 2 strike prices. So you'll take specific notice that all of the stocks had about $10,000 allocated to each position, which is great. However, CMSCA was the one that was kind of out of whack a bit because it had 22,110 allocated to it, and that would be the second row from the top. So the first thing that I would tell Carl is, you're too heavily weighted in this particular covered call writing portfolio in CMSCA. I would cut that one in half. Other than that, it really is a great allocation regarding the cash because all the other positions are right around that $10,000 mark. Now, in order to see the calculations, we're going to use the multiple tab of the Ellman Calculator. And the cells on the left-hand side, the blue cells, is where we put in the information based on what Carl sent to me. You could see the column all the way to the left gives the ticker symbol of the stock. You'll note once again that 2 of the stocks, CMSCA, PPC, have 2 positions because there are 2 different strikes. The cost or the value of the stocks, price per share at the time the trades were entered, is listed in the second column from the left. Then the option premium, the strike price, again, they're all out of the money or higher than current market value, and they all expired on 12/15/2017. Now, once those cell entries are made, the white cells on the right-hand side automatically become populated. There'll be no intrinsic value because there were no in-the-money strikes, but there'll be upside potential on all of these positions. And of course, every position has a break even, which is always the price per share at the time the trade was executed minus the entire premium. All right, now let's move on to the ROE column. return on option, which is the premium divided by the price per share. And you could see starting at the top, ABBV had a return on option. These are all 1 month options of 1.6%. At the bottom of that column, PPC with the 35 strike had a return on option of 1.9%. Now, I highlighted CMSCA with the $40 strike because that one had a return on option of 0.4%. In my mind, that's too low for a 1 month return. It's too low. It may be appropriate for some investors, but for most covered call writers, that's going to be too low. So that's the only problem I would have so far with these root calculations. Now, if we averaged out all of these positions, Carl's 1 month return on option, time value return on option, before any share appreciation up to the strike price, it averages out to 1.9%, which is excellent. So far so good with that one minor little blip with the 40 strike on CMSCA. Now let's move over to the second column from the right, which is upside potential. And we could see starting at the top with ABBV that it starts at 3.1% and it goes down to PPC with the 35 strike at 3.4%. If we averaged out all the upside potentials, it would average out to 3.4%. So if every position worked out to its maximum, Carl would receive an initial return of 1.9% on the premiums, and then an additional 3.4% on upside potential, which means from current market value of the stock price when the trades were executed to the strike price when the contracts expired, leaving a 5.3% 1 month return on this portfolio. Pretty good if everything fell into place precisely. Of course, most of the time it doesn't, so the returns usually won't be that perfect, but they should almost always be pretty good, particularly in neutral to bull market environments. All right, so now it's time to give Carl a grade because that's what he asked for. So let's have a look at Carl's scorecard for these 1 month positions. Regarding his cash allocation, well, let's start with his stock allocation. He used 5 different stocks in this portfolio, so I'm going to give him an A for that. He could have started off with 3 stocks and then I would not have given him such a high grade. But he took his $60,000 investment and put it into 5 different stocks. So good for you, Carl, on that. Now, cash allocation, I'm going to give Carl a B+. And that's because he had 5 of his positions at 10 grand and 1 at 22 grand. So got to do something about that 22 grand to bring it down to where the others are. And the way to do that with CMSCA, instead of using 600 shares, use 300 shares. Now you got something going on here. Okay, now as far as option selection, I'm going to give Carl an A-. They were all out of the money strikes. So if Carl had any concerns about any one particular stock or the market in general, then some in the money strikes should have been used. But he used all out of the money strikes, so let's assume that Carl was bullish on the market and all the chart technicals were bullish. We'll make that assumption. The only concern I have is for that $40 strike for CMSCA, which gave a 0.4% 1 month return. It just isn't enough. So I would have not used that particular strike. All right, so the average returns of 1.9%, again, that's for the premiums, the time value premium only, is very good. And the upside of 3.4% also excellent. So overall, this is a very, very good first portfolio for Carl. I commend you very much for that, Carl. All right, let's just kind of review everything now. We want to have at least 5 different stocks to get our portfolios launched. Unless you're using exchange traded funds, then you kind of have automatic or instant diversification. You could use less positions. But for stocks, at least 5 in 5 different industries. And we want to allocate a similar amount of cash per position, which Carl did with one minor little blip on the screen, CMSCA. Favor out of the money strikes if you're bullish on the market and chart technicals are bullish and confirming. And in the money strikes, if downside protection is required, and that would be in a bearish or volatile market, or sometimes when chart technicals are mixed as opposed to all bullish. You can also ladder strikes when you're using multiple positions, which means in one particular position and strike, you could use some in the money and some out of the money. For example, with PPC, Carl had 3 contracts. He could have used 2 out of the money and 1 in the money, or any combination thereof. However, we're going to make the assumption that Carl was bullish on the market and he did the right thing. Now, once we enter our positions, we want to make sure that the time value returns meet our goal. So set the goal first and then select your option to make sure you're meeting that goal. In my case, it's 2 to 4% for my initial time value returns, and then I'll know whether a particular strike is appropriate for my portfolio based on the goals that I set before I bought the stocks and sold the options. And then once the portfolio is established, then we automatically move into position management mode, which can be automated. You know, we buy back the call options using the 20%, 10% guidelines, so that can be set up as soon as we enter our position. Buy the stock, sell the option, and then put in a buy to close buy order at 20% the first half of the contract, 10% in the second half of the contract. So that can actually be automated, although I do highly recommend having a look at your portfolio at least once a day. Overall, Carl, you're off to a phenomenal start. Congratulations. And I want to thank you, Carl, for sharing this information with me so that I could share it with our members. It's a great learning tool. And of course, thanks to everybody out there for taking the time to watch this video. I hope you enjoyed it. And most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.